When I was getting my first few rentals, I found networking at a local REI club absolutely a waste of time. Most of the people you network with, especially in random networking events, will not lead to anything. The running joke amongst sophisticated investors is that the local real estate club is the worst place for us passive investors to find peers, because it's just a bunch of broke people. That's why people are seeking real estate advice to get unbroke. Hashtag BP. For the same reason, I am turned off by the 10x Grant Cardone followers because they are really a ninja in disguise. No income, no job, no assets. In some cases, they have a scarcity mindset motivated individual willing to step over whoever they need so they are not broke anymore. For more networking tips, go to SimplePassiveCashflow.com/people. Since 2016, I've given hundreds, almost thousands of free calls to my podcast listeners. And now you can chat with me, but you gotta join the Hui Deal Pipeline Club. I do this to filter the right people into my circle. I'm always watching and taking notes. Tip: I give freely and generously to those who reciprocates and exhibits generosity. Some people are givers and other takers. I've left so much money on the table giving out free advice, contacts, and resources. This is the way I filter people who I want to work with in the future. Ultimately, I play the long game. The Mastermind Journey to Simple Passive Cashflow is a platform to find like-minded, curated, not broke people or jerks, and the best chance for a busy adult to meet lifelong friends, even when you have graduated from the program. For the price I'm offering for the networking alone, it's worth it. But wait! By the way, you get 27 weeks of organized content and bi-weekly semi-private coaching calls too. SimplePassiveCashflow.com/journey to learn more.
This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went try to rent them out. And then he became one real investor man.
And the Fed helped pay for that by creating $3.5 trillion out of thin air and buying government bonds through quantitative easing, all without creating any significant inflation at the CPI level whatsoever. And so this is what we're going to see more of in the future. As long as globalization persists, we're not going to have high rates of inflation at the CPI level. And it's going to take more fiscal stimulus from the government and more quantitative easing from the Fed to keep the economy growing. Now, many people find this alarming. I mean, common sense suggests this is somewhat alarming. But whether you like the idea or not like the idea, you should recognize that this is the most likely scenario of what is going to happen. You might prefer that it play out in some other way, but it's probably not going to. If you want to understand the financial markets, you have to understand the reality rather than ideally what you would like to see.
Got some dry powder, right? The interest rates have gone up to 2.5, and ideally, it took us a long time to get there, and we've got some dry powder to go back down. Where is this kind of coming to a head with, the United States putting tariffs on China imports? Where do you think this is going, and as it sort of keeps escalating?
So this is a real worry, of course, because on the one hand, if we have an all-out trade war with China and globalization breaks down, then we won't have access to cheap labor. And in that case, if the government runs a very large budget deficit and the Fed creates a lot of paper money, and we don't have globalization anymore to keep the deflationary forces flowing, then we're going to end up with high rates of inflation. And if inflation goes up, then of course interest rates in the US would move much higher. And if interest rates move much higher, then the stock market would crash, and creating a very negative wealth effect. And at the same time, credit would contract because it would be less affordable. And that would also cause a very severe economic crisis. So the greatest danger of facing our future is the possibility that we would have higher inflation if globalization collapses. On the other hand, it is true that China is a threat to the future of the United States, in that it is growing so rapidly. It is going to soon overtake the United States as the most powerful economy and technological and military superpower if current trends continue. And it is true that they have manipulated their currency for decades, and at the same time that they forced technology transfers and protected their markets unfairly. So that can't be allowed to, the current trends can't be allowed to continue either if the United States is going to retain its global preeminence and security. So we need to find a strategy that will allow us to continue to have globalization, but to allow us to grow rapidly as well. So given all of these circumstances, I think the best strategy would be for the United States government to borrow and invest in new industries and technologies very aggressively. I believe the government is going to continue having these massive budget deficits in any case. So we need to have a public discussion about how the government is going to spend this money. Of course, they could spend it wastefully, having a war with Iran, for instance, or having a war and continue to have excess consumption. Or they could spend the money investing in 21st century technologies. They could invest aggressively in artificial intelligence, genetic engineering, biotech, nanotech, neurosciences, robotics, and green energy on such an aggressive scale that it would induce a new technological revolution. And it would allow the United States to continue to maintain its global preeminence. It would make the economy grow much faster. And it would create technological miracles and medical marvels that would improve the health and well-being of not only every American, but everyone alive. So in this, where we find ourselves in this unique moment in history, where the government really has no choice but to continue borrowing and spending, and the Fed can finance this through paper money creation, this gives us an opportunity to invest in these new industries on a very aggressive scale. And if we do that, not only will we continue to keep the economy out of depression, but as I said, we will induce a technological revolution that will vastly improve human well-being.
So I think the average real estate investor is out there thinking to themselves, I mean, it all kind of sounds like Star Wars to them. It's very, it's something outside even our country. We've been told to think that, market cycles last anywhere from 8 to 12 years. And now we're in the sort of the longest ones ever. Is that 8 to 12 year rule still apply, or has this kind of just been blown out into the water? Who knows how long this bull market will last? Right.
So yes, this is the longest expansion of the economy ever. And it hasn't been a very strong expansion. Normally after you have a recession, the bounce back is a few years of very rapid economic growth, which we've never had in this expansion. But the only reason we had any bounce back at all is because of government intervention with these huge budget deficits and this extraordinary amount of paper money creation. So right now, the total debt of the US government is just a little bit larger than the US economy. The government debt is about 106% of GDP, so just a little larger than the economy. So this is almost as high as it was at the peak of World War II. And so therefore many people think that we're on the brink of disaster and the government's about to go bankrupt, et cetera, but that's just not true. Japan, for example, the Japanese economy went into crisis in 1990. And at that time, their government debt to GDP was 60%. Well, since then, almost every year they've had very high budget deficits, and their government debt is now 240% of GDP. So the US economy is roughly $20 trillion in size. So that means the government debt is something like $20 trillion, let's say. So the US government could borrow and spend an extra $20 trillion before it even hit 200% government debt to GDP, whereas Japan's already now 240. And of course, if the government borrowed and spent that much money, the economy would grow by 10% every year. So we would never get to 200% debt to GDP. So we have the potential to continue growing government debt realistically. Again, I know many of your listeners must be cringing at this thought, but there is nothing to stop US government debt from continuing to grow for not only years, but decades. And so the sensible approach is just to come up with a good strategy on how to use this money that the government is going to borrow, rather than using it wastefully. they say that Japan wasted all this government money by building bridges to nowhere and paving the Japanese countryside with cement. If they had understood in 1990 how much government debt their government was going to take on over the next 30 years, they would have come up with a brilliant plan on how to invest that money in new industries and technologies. But they didn't. So the US can learn from the Japanese experience. Our government debt is going to continue to grow. What we need to decide is how to use this debt to improve the well-being of everyone in our country by investing in new industries and technologies. That's my recurring theme. But from a business perspective and an investment perspective, I think it would probably be a mistake at this point to assume that the end is nigh and to bury your gold in the backyard, for instance, because the end is not nigh. This is going to continue for a long, long time. We're not on the brink of bankruptcy. And as long as there's no inflation, this can go on for decades. So the biggest threat to our prosperity, a visible threat at least, is that globalization completely breaks down and trade tariffs go up around the world. And then we don't have the deflationary forces from globalization and we get high rates of inflation. And then all bets are off. In that case, we could have a very serious depression. But until that happens, I think people should not fear that the U.S. government is on the verge of bankruptcy anytime in our lifetime.
Unless something trips us up for the short term and puts us into another, maybe little recession, like a China trade war going haywire or something like that.
That's right. And of course, all kinds of things that could go wrong. I mean, if our trade war, in fact, has already become something of a Cold War. And it's not inconceivable that the Cold War could become a hot war. So in that scenario, certainly all bets are off and everything could go terribly, terribly wrong.
So where is this trade war going? I mean, right now, United States is doing tariffs on imports now. I guess putting yourself in the perspective of the Chinese, I mean, it's basically on them, or is it on the United States to sort of propose an end to this?
So my interpretation of what is happening is that, and of course, at first, when President Trump was running for office, we couldn't know for sure whether he really meant what he was saying about China or not and stopping China. And the first year they focused on cutting taxes. And once that was done, though, then he did turn his attention to China and started to ramp up this trade war gradually and then more aggressively. And we've seen Vice President Pence made a speech in November last year that called China out on a broad number of fronts, not only economic, but political and across the spectrum. We know that President Trump is being advised by Peter Navarro and other China trade hawks. Peter Navarro, as you know, has written a book called Death by China and a number of other books with similarly alarming titles. And these people really believe that China is a grave threat to the future of the United States. And they want to stop China's rise. So it's become clear that this trade war is not just about trying to balance trade, but it really does seem to be about trying to stop China's growth and prevent China from overtaking the United States. So right now we've reached the point where we have tariffs, 25% tariffs on more than $300 billion worth of Chinese imports. And it looks like there is a pause. President Trump, of course, has to be concerned about how the economy is going to be between now and the election in November next year. He doesn't want to take further actions that will slow the economy so much that he loses the election. So we may see some sort of truce where things don't become worse, but things don't become better. And then after the election, if he is reelected, I would imagine that he will further intensify the pressure on China and continue hiking tariffs, in order to damage China's economy. And China is not going to give in. They're simply not going to do what President Trump is demanding. In fact, what he's demanding has almost been designed to ensure that they can't comply with what he's demanding. They're not going to do that. So there's a real possibility.
It's sort of like starving or smoking out China, right? At some point, they're not in the strongest position internally to outlast these kinds of trade demands. Are they in a better position, or are they in a weaker position? At some point, they have to cave in.
Well, they're not likely to cave in because they have, no one in China has to stand for election ever. So the Chinese people can endure a whole lot of pain before, it would effectively take a revolution to force the Chinese government to do something it doesn't want to do. And that's not going to happen. It's extremely unlikely. So they're not, I don't think they are going to give in. But if the danger is that, so the trade war does intensify, we put up higher tariffs. On the one hand, there's the risk that China's economy will slow down, go into significant recession, which will drag the world into significant recession. That's one danger. And in that case, we'd continue to see low interest rates, perhaps. But the other danger is that if you put trade tariffs on all of Chinese goods, that's going to push up, of course, the price of Chinese goods that are sold in Walmart. And that will push up interest rates, inflation and interest rates. So the other scenario is that tariffs ultimately result in higher inflation in the U.S. and higher interest rates, and that crashes the U.S. economy. It could play out badly either way.
Or maybe they cancel each other out. Is that a possibility?
Well, at the moment, that seems to be what has been happening. We've had these higher tariffs, but the 25% tariffs really didn't go into effect until the end of June. So it's going to be interesting to see over the next several months what the knock-on effect of that is on prices in Walmart, on consumer goods. But thus far, we haven't seen any significant impact on prices. But again, the tariffs just took full effect at the end of June. So we'll have to wait and see, but it's a worry. And of course, if China's economy goes into a severe crisis, there's no telling how they will respond. For instance, we should keep in mind some history lessons. In June of 1941, the United States put an oil embargo on Japan, and 6 months later, Japan attacked Pearl Harbor. So if there is a risk that the U.S. measures drive China's economy into a severe crisis, that they will respond in ways that don't only involve economics.
Right. So I guess, many things ahead. And other than the China trade war, what's the kind of the secondary bump along the road that you're seeing coming up that could derail this party train?
Well, so again, I'd just like to emphasize, so rather than going down this road where we, force China's economy into crisis with severe global repercussions, it would be a better strategy for the U.S. for the government to borrow and invest in new industries and technologies on a very aggressive scale so that we can rev up our economy. And rather than, if we're afraid that Huawei, the world leader now in 5G technologies, if we're doing all this because we're afraid China is going to overtake us, the reason China's potentially going to overtake us is because their government invests much more in new industries than our government does. Well, if that's the problem, the solution is for our government to invest much more in new industries than their government does. And then we can solve this worry and avoid a global economic crisis and potential military crisis. So that's the solution and the hope that I think the approach that I advocate. Now, so I think we've talked about the big issues. I think the most important thing for investors to understand is that in this modern world where money is no longer backed by gold the way that it was up until the early 1970s. In this new system we live in, creditism, credit growth drives economic growth. If we don't have enough credit, the economy goes into recession. So that's important to understand. Next, liquidity is the thing that determines whether the asset prices, the stocks and the property go up or down. what do I mean by liquidity? Well, essentially, it's the amount of money that the central banks create. And so it's credit growth drives economic growth. Liquidity determines whether asset prices move up or down. And the government is pulling the levers, is doing everything that it can to control credit growth and liquidity in order to make sure that the economy doesn't spiral into a new depression. So those are the things that I always focus on in my work with MacroWatch. I monitor credit growth, liquidity, and government policy to see how these things are going to impact the economy and asset prices in the weeks and months and years ahead.
Right. So that was something, I just kind of joined onto your membership site, and I'm always kind of looking for new things to kind of spend my money on, especially for the Mastermind members. If you guys want to join that, go to SimplePassiveCashflow.com/journey. But as I've always said before, you got to kind of pay to play and to get some of this better information out there, as opposed to, I think too often out there, people are skimming on like the free stuff, that free 1 hour webinar that you're getting, and it's the same, bunch of garbage again and again, as opposed to, the good stuff here. I'm going to display the membership site here, if you don't mind, Richard. Just so some of the, you do what, like a video every couple of weeks or so here?
That's right. Every couple of weeks, I upload a new video. These videos are essentially me making a PowerPoint presentation. So there are lots of charts that can be downloaded, and I take the subscribers through these charts and explain what they all mean. And
Yes.
So every 2 weeks, I upload a new video, and plus people who subscribe, they have immediate access to all of the videos in the archives. This MacroWatch was launched in 2013. So there are now more than 50 hours of videos in the archives that subscribers have immediate access to. And I group these under categories so that people can, there's a video index so that people can look through the archives and find the topics that interest them most. And I've also made 4 courses. The first one was called Capitalism in Crisis. The next one is called How the Economy Really Works. There's one on monetary policy, and there's one on China's economic crisis. So each one of these, several hours of videos explaining all of these very important subjects that drive our modern economic system and our wealth.
Right. And I think what I like about it is, I just kind of joined on last month, is there really isn't too much stuff. It's more quality over quantity. For a while there, I was only doing the podcast every couple of weeks. Now that I don't have a day job, I can do this every week. But, this is the opposite of your everyday podcast. We don't got time for that garbage. We want good stuff. And I think I had up here a little while ago, the you had it arranged by date. I think it's a good amount of quantity that you're putting out here too. So so what would you say, I just joined this past month, what would be the most, obviously I'm not going to spend 50 hours, not even 8 hours watching these videos. What would be the best way to just kind of jump in and start absorbing? I always tell my guys in my mastermind, we're going to do the minimum effective dose. We're busy working professionals. What's the best, your recommendation to tackle this?
Well, so MacroWatch really is designed to teach people how the economy really does work now in the 21st century. It doesn't work the way it did in the past when we were on a gold standard. All of the classical economic theory that is still being taught in the universities doesn't explain how the economy works anymore. So MacroWatch does. And if you are a real beginner at economics and don't really know very much about it at all, I would suggest beginning with the course called How the Economy Really Works. And that economics is not rocket science. You don't need to know calculus and physics to understand how the economy works today. It's just not that complicated. And I explain it in very simple terms. So if you're a beginner, start with the course called How the Economy Really Works. If you're quite knowledgeable, what I would suggest is then beginning with the course called Monetary Policy. I'm very proud of this course in particular. I've been working on a new book, and as I have gone along, I've made these courses on the subject that the book was going to be about. For instance, one of the videos is a history of U.S. monetary policy. This effectively describes how the Fed has conducted monetary policy since it was created in 1913. It covers 7 different periods by looking at the Fed's balance sheet, how the changes in the Fed's assets and liabilities explain how the Fed has conducted monetary policy. And if you watch this course, you will be an expert in U.S. monetary policy. And it's not only in this course, we also cover monetary policy in China and in Europe and in Japan. So you will have a comprehensive understanding of global monetary policy, and global monetary policy is now the most important force driving the global economy. It's the most powerful policy tool that governments have to control our economic system, and that's what they're using to make sure our economy doesn't collapse.
So I will, this is something that I've kind of added to my reading material and viewing material. Definitely be talking a lot about it in our bi-weekly mastermind calls. I'll be kind of, we run out of stuff to talk about. I'll definitely chime this in, and you guys will likely hear a little shade of this in the future podcasts as I kind of bring in my commentary. But as always, do your research on your own. If you want to get your own subscription to this, I think it's $500, but you've got a little discount for Simple Passive Cashflow listeners. Go to richardduncaneconomics.com and use the coupon code LANE, Lane. We were very creative in putting that one together.
That's right. If you go to richardduncaneconomics.com, hit the sign up now tab, and it will ask you for a coupon code. If you type in Lane, you can have a 1-year subscription for $249. So that's a 50% discount. And as I said, you will have access to, you can become an expert on how the economy really works now, and you will then be in a position to judge for yourself how new developments are likely to affect the stock market, the property market, commodities, currencies, gold, oil, your assets.
Right. So if you want to be a cheapo and just get my Laneism renditions and summaries, keep listening to my podcasts. Thanks for coming on, Richard, and kind of breaking some of this stuff down. I definitely learn a lot. If people want to get a whole contact with you, go watch some of his videos. Sign up for his thing. Don't ask him questions. Everything's out there on the internet. He's created so much, 50 hours of content. Wow.
Well, thanks, Lane. It's been a pleasure talking with you. I've enjoyed the conversation. Let's do it again sometime.
All right. If you guys have any follow-up questions, shoot it over to me, Lane, at SimplePassiveCashflow.com. Join the free investment club, SimplePassiveCashflow.com/club, and we'll check you guys next time. Bye.
This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.